So just a quick show of hands. How many of your portfolios are near all-time highs? Or even better still, broke new record highs? Maybe you can share it in the comment section down below. At least based on my own social algorithms or people near me, they're increasingly humble bragging or flexing that their portfolios made new records. And rightfully so, especially if you're invested in the US market. Because if you were to look at the S&P 500, and they're just 3.8% shy from its recent peak all-time high at the start of this year. And we have really witnessed this incredible V-shaped recovery, and the market continues marching on with a sheer disregard of many of these Trump tariff talks and potential recession of some sort. And for those investors who took advantage of this very sharp decline, are probably reaping their rewards. So in this video specifically, I'm going to cover 4 key points. It's the US bear date, my own personal portfolio sharing, my stock priority list, and last but not least, I actually asked ChatGPT to critique my portfolio to first talk about this idea of whether the US bear is dead. I think it's quite obvious that quite a lot of all these US bulls are starting to come out to celebrate their victory. Talking about the new bull market coming in, showing you a flurry of statistics and how buying the dip will always result in good performance in the long term. And I think rightfully so, especially when you have 100 years of data backing you up. And clearly, in this most recent episode from Feb to April of 2025, from peak to trough, the S&P was down roughly 21%. But I think in comparison to all other 23 previous bear markets, this is actually considered one of the shallower ones. And of course, nobody has the crystal ball into understanding which stage of the bull cycle are we currently in. And on the flip side, we have another group of investors constantly sounding the alarm bell, quoting things like the S&P 500 forward PE is currently at a spicy 21 times, and the Nasdaq at 27 times. So when comparing this range of valuations relative to their 20-year distribution, when looking at the S&P 500, 21 times is at the 5th percentile range. And with not much context, you probably have to draw your own conclusion. But I think to put things into perspective, only the S&P 500 is sitting at such a high bar or high range. When you look at the Russell 2000 or even the mid-cap index, they're actually close to their 20-year median. And yes, one of the plausible arguments is that many of these high-quality top tech titans are gobbling up a bigger and bigger market share of the S&P 500, and generally, they do trade at a much higher valuations compared to their other counterparts. Therefore, when you look at it from a 20-year horizon compared to 2005 versus today, so clearly the makeup of the S&P will definitely be on the higher range, but that doesn't mean that the S&P is overvalued per se, because it's now constituting more and more of such very high quality tech companies that are very globalized. They earn huge amount of margins compared to their other predecessors, and more importantly, the growth runway ahead for many of these AI related companies like your Nvidia, Microsoft, Amazon and Meta, they have huge growth runway ahead. That's why investors are ascribing a premium valuation. If you flip it to the bearish side, a mean reversion is bound to come, and this high quality argument has to withstand the test of time. Now, what about looking at the real economy? So looking at the most recent Visa and Master earnings call, they had identical takes on the US consumer. So spending is solid through May, despite dire sentiments and macro rhetorics. And they both cited solid labor market, and Visa says international markets are resilient too. So here's what they have to say. We had the first quarter data, and we had it up until the 28th of April, and spending trends were stable at the time. Now, if you're to include the first 3 weeks of May, we see exactly the same. You see a lot of rhetorics there, and you see a lot of headlines, and it hasn't really translated into consumer behavior, unquote. And the facts, as we get them, is that employment numbers looks pretty good. Wage growth remains relatively stable. And even coming off a relatively strong quarter that we saw in December, that remained relatively stable. And we are seeing similar trends in most major markets around the world as well. So looking at this pricing mechanism called the stock market again, there is a lot of people front-running many of their expectations at the start of the year, but as the data shows it, I think we are still looking at a pretty strong economy. I think all things considered. As always, I show this Excel sheet outlining my entire positions, and I've recently discovered this really interesting platform called Potsado. And there is this very interesting feature on Potsado, which I've been looking around for months. I'm basically trying to come up with a parallel portfolio, and depending on the benchmark index that you choose, they're able to tell you that or compare your performance compared to if you are doing your own stock picking versus investing into the benchmark index. And comparatively, when pulling in or potting in all my transaction data from the start of end of 2020, if I were to invest in the S&P 500, I'll probably be better off by, I think, $6,000. Because I've always been trying to track my performance compared to the S&P, but the normal brokerage statements only allow for the individual benchmark index and basically just giving you one consolidated number and not based on your own input and output. So just looking at Potsedo, they give you the breakdown of your key stats, what's your all-time high figure, tabulate automatically your realized gains and your dividend income as well. Now, when looking at your performance, you can of course do so via the 3 key returns framework. One is called the money-weighted return, second is the time-weighted return, and lastly, it's the simple return. And when you compare, actually there's a very big difference, at least for my portfolio. Money-weighted return, I'm up roughly 42k, I'm 59%. On a simple return basis, it's up 24% because you basically just add up the unrealized and realized gains towards the capital base. And here's the shocker, on a time-weighted return basis, I'm actually down 30% on a portfolio level, but nominally speaking, I'm still up. So what exactly are the differences? And why does it matter? And I think on a simple return basis, it's basically your total gains divided by your initial invested capital. So that's pretty simple. But I think specifically for time-weighted return, what you're basically doing is to ignore the size and to compute the return separately in each sub-period. What you're trying to do is to basically measure your ability as it tries to average your ability over time regardless of the portfolio size. Money-weighted return is where you combine both time and size. And by capturing both time and size, its limitation actually comes out only when your cash movement decisions are not based on investment reasons. So long story short, if you think that I'm speaking gibberish, if you want to look at a benchmark index performance or a portfolio manager who doesn't control the ins and outs of his cash flow, then a time-weighted return benchmark would be fair because that kind of standardizes the ability to manage or allocate the capital in that sense. But when you talk about it on a retail investor front, because you basically have full control over the cash in and outflow, and if you want to take into account the quantum of the gains and also the timing of the cash flow, then you need to look at money-weighted returns because they actually give more weight to the performance when the portfolio size is the largest. And so for those of you who have been following me for a long time, you know that I've been stuck, quote-unquote, in this Chinese tech bear market for a very long time. And fortunately or unfortunately, in the earlier part of this portfolio building process, I've went all in into one stock before or even 2 stocks. And back then, also, the consideration that the portfolio size was relatively smaller and I don't really have a very big or very active income. And back then, because of this input, a large part of the drawdown has been incurred at the first half of the portfolio building process. But I think in the later part, when I'm starting to earn an active income after I graduated, I start to do a little bit more portfolio diversification. And of course, when the portfolio grew in size, that's when my performance started to kick in a little bit more. And that's why I kind of started to chase back to the S&P 500 returns, which is where we are currently sitting at today. And of course, in all transparency, I'm willing to show you. So this is basically the breakdown in terms of my average cost and the market value allocation. And yeah, like I said, I think a very outsized allocation to both Alibaba and Tencent. And looking at the performance-wise, when just clocking in the money-weighted return, I'm sitting at roughly 10% annualized for the last, I think, 4.5 years. And of course, I'm still trending behind S&P 500 and the Nasdaq. But yeah, I do believe that a very large part of my conviction still lies in the Chinese tech space. And I don't think that they are near anywhere in this whole recovery arc, so I'm still very heavily positioned in them. And a very good part about this platform is, of course, they do a projection in terms of your dividend income, and depending on the baseline denomination of the portfolio, whether you are a foreign investor or not, they help you do most of the calculations. And I was also playing around with many of these other features. I think this trade analysis tab is spectacular. They basically allow you to look through, audit your own transaction statements with clear intellectual honesty, looking through the years, especially during the down bear market. Have you actually bought more, and are you congruent with what you think you are doing? And more importantly, in a very graphic way, allow you to see that really during a downturn, are you buying more or are you actually selling out of your position? So yeah, this is just my 2 cents. And for those of you who are asking who's Potsedo for, I think if you have multiple portfolios across different brokerage platforms and you have too many Excels to keep track of, or you have too many positions cutting across the different geographies, and the foreign exchange has been a headache for you in terms of your data or number crunching. And if you want to run a parallel portfolio, basically what if you invested in a benchmark index instead? And I think, to me at least, I think that's a true benchmarking of your personal performance, especially when you do control the cash in and outflow. And I've personally loved the platform, and they do provide a 14-day free trial. So after 1 day, I actually converted myself to a pro member at roughly $12 per month. So this video is not sponsored by them. I just wanted to share that I think moving forward from here, I will be aggregating or presenting a lot of my portfolio data from their platform. And for those of you interested, there is a link down below. Now, pivoting back to where my portfolio currently stands, I think it's fine and dandy to know how much each position based on the weightage and exposure as well. But I think it's also important to kind of have a feel and to understand what exactly is the valuation of my overall portfolio. So I actually took the liberty to consolidate some of these very mainstream or traditional price valuation metrics. You have your PE, price to earnings, forward price to earnings, to operating cash flow, to free cash flow, and the free cash flow yield. And on the other hand, I've also consolidated the return on equity and return on invested capital, which to a very large part, most investors will look at them as a tracking of the business fundamentals or the quality of the business. And of course, looking out into the future, the revenue projection of the next 2 years based on the consensus analyst forecasts. So if to strip away the right side, just focus first in terms of the valuation matrix, you can see that a large part of them, when you just focus on the price to earnings and forward price to earnings, most of them probably revolve around the 15 to 20 times, unless they are relatively high grower or they are those that actually spend a lot of their earnings back into the business. So of course you have your ASML, your Nvidia, and your Amazon. I think they do stand out because of that red hue, because they do kind of tend towards the over 20 to 30 kind of range. But I think that's it. When just looking at my top 2 positions, they are definitely on the lower side, much lower, because they are your Chinese tech companies. And despite this recent recovery, I think there are still, based on any traditional metrics, I'm still trading at a relatively low valuation. Now, if you to pivot over to the cash flow side of things, I think they are showing a darker hue of the blue, meaning to say that they are of a relatively lower number when compared to the price to earnings. So I think not much worries on that. And even when looking at companies like Amazon, I do like to look at their price to operating cash flow instead of their PE. So at 19 times, I think still relatively attractive. Now, if you to flip over to free cash flow, that's when you see the impact of a lot of all these reinvestment efforts into their capital expenditure. And of course, the 2 companies that stand out is Amazon and Nvidia. Looking at their free cash flow profile, they are not printing a lot, yet at the same time, they are investing quite a bit, at least for Amazon's case. I think for Nvidia, their free cash flow will continue to explode as their top-line revenue growth rates actually do increase. But I think looking across the board, I think they're still relatively healthy, because when you look at the yield, they are hovering between 4 to 5%, with a few exceptions here and there, of course. So that's generally how I look at a broad-based overview of the portfolio today, based on valuation matrix. Now, pivoting over to business fundamentals, I think looking at return on equity and return on invested capital is just looking at how effective or efficient the company is reinvesting all the additional capital into other businesses or their existing business. And by highlighting them in red, I actually use the benchmark of 15%. So if you have a higher than 15% ROE or ROIC, I would deem you to be a pretty high quality business. Yes, I think a lot of all these Chinese tech companies, specifically Alibaba, Tencent, and Meituan, they don't hit that 15% mark. Of course, you can take into account your things like macro headwinds, slow consumption market, slow expansions in the last 2, 3, 4 years. But that's it. I think when we look at this recent recovery and a lot of investors are baking in their expectations, I do expect at least some of these business fundamental trackers to start trending back up. If not, I think if there is a sustained low, mid to high single digit ROIC, would probably suggest that the business fundamentals have kind of deteriorated over the years. I think when looking at some of these outsized, crazy capital allocators like ASML and Nvidia, which are the 2 more recent buys or adds in the portfolio, which is why they make up such a small percentage, crazy numbers that are printing from their core business, and a lot of investors are going crazy around them. That's why they are beating up their share price. But yeah, barring any black swan or any big miscalculations in terms of their revenue estimates, I think they kind of are deserving of their current so-called monopolistic kind of valuations. I wanted to have a blended mix into understanding where the portfolio currently stands. I actually took out the VOO and VWRA because they are ETF positions in the portfolio. And this is the final number that I've gotten based on the portfolio sizing attribution. And if I do refactor it back to 100% and I take the S&P 500 PE and forward PE into consideration, the portfolio is currently sitting at roughly 21 times trailing 12-month PE and 18 times forward PE. And compared to the S&P 500, I think relatively speaking, we are still sitting at a cheaper valuation. And I think a large part is because of my outsized allocation to many of these Chinese tech names. And if you look at the current portfolio breakdown, I think I'm quite happy as where it stands. And I do see pretty much quite a big upside. At least that's what I'm betting on with my own real money, and also try to balance out the equation by adding to a bigger exposure to some of these US names as well. And of course, looking at my own priority list, I like to focus on the existing positions first because there is a reason why they are already in my portfolio, and especially so if they are at a comfortable valuation. And in fact, I do prefer idiosyncratic risk more compared to a broad-based market risk, because when there is a broad-based market sell down, sometimes you get very distracted. Companies should you add first over the other. And if it's an idiosyncratic risk, if it's just one company basically taking a nosedive, then I'll be a lot more confident in terms of taking advantage of that opportunity. And also adding to existing position first, rather than try to build conviction into a completely new stock. That's just my general principle. So in terms of high priority, and all these are in order, I would like to add more ASML, then Meituan, then TSM, then Nvidia. And just looking at this first tier or high priority list, you can see that out of the 4 names, 3 names are in the semiconductor space. So I think when looking at my own portfolio, I think looking at these semicon names as a sector exposure, they're currently sitting at roughly 7%, 7-8%. I do want to kind of bump it up a little bit more and be more aggressive in my exposure to maybe 10-12%. So that's why all these are clearly at the very top part of my priority. And of course, Meituan, I'm working on a separate deep investment analysis video on them. I've gained a lot more insights talking to a lot more people about the business, and I'm falling more and more in love, even though I know that it's dangerous. But yes, in general, I'm getting more and more comfortable, building more and more conviction in the business. That's why I can see that Meituan as a position suddenly bumped up to 5.5% because I've been aggressively adding to them in the last few months or so. Now, moving on to middle priority, still look towards the mega tech stocks. Google, Amazon, then Meta. I do rank them in terms of valuation concerns today. I think Google is the most attractive, followed by Amazon and Meta. But I don't think that I will add based on this order. I can be adding to any 2 or 3 of them at one point in time. And of course, low priority, I do want to add more Lulu and possibly Tencent if they do come down in valuations, and of course the rest. These are kind of the 7 companies that are at top of mind. Firstly, I think for ASML, it is already in my priority list and it is already an existing position. I do see them as a near monopoly and a very huge stake in this AI tailwind runway. So that's why, because of their near monopoly stake, there is certain considerations with the China market, yes, for Nvidia too. But because of their position, they are able to levy a very huge level of pricing power, and they are mission critical in the next frontier of growth. Therefore, I do think that they're quite insulated by many of these macro conditions or whatever Trump tariff that they're going to enact. Moving on to Ferrari and Hermes, they operate in the super high luxury space, incredible pricing power. I've always wanted to own them, but valuations has always been pretty high. So I do hope that if there is a general broad-based market sell down or just people punishing some of these luxury players, I do look forward to scooping them up. But for now, I think still valuations are pretty high, at least for my own taste. Moving on, I think for Tencent and Meituan, they are both a consumption play and a tech play. They mostly derive their revenue in the Chinese space. There is not much effect from many of these Trump's antics. And lastly, I have Visa and Master as a potential idea as well, because they do take a blanket consumption tax. They provide the railway networks for all financial transactions. They're a duopoly as long as we don't go into a deep or steep recession. But I also always prefer them on lower valuation fronts. But I think at this rate, I probably can only buy them during a recession when there is a blanket level panic. And that's my general thoughts around this whole Trump investment framework idea. At the last part of this video, I basically prompted ChatGPT to destroy my current portfolio allocation by giving them a screen grab of the Potato breakdown. And here's what GPT has to say. So the first point, China roulette, 60% of the spin. Even between Alibaba, Tencent, Meituan, Maotai and Haidilao, well over half of the money rides on one political economy. Regulatory crackdowns, delisting, opaque accounting, pick your poison. And if Beijing sneezes, your portfolio gets pneumonia. Geographic diversification, this ain't. I think, of course, clearly, for those of you who have been following me, you'll know that I'm a huge Chinese bull. And exactly because of so much uncertainty and worries, that's why we are presented the opportunity. And I wouldn't shy or back down from the fact that I'm not diversified at all, whether it's from a geographical perspective or an individual position perspective. But that said, I think that has been the way that I operate my portfolio. I'm the investor and the manager at the same time, and I'm comfortable with the risks so-called associated with them. And I've done quite a bit of homework in terms of your idea of delisting, the crackdowns and so on and so forth, and how they are leading or charting the way forward. Because it takes a certain degree of personality and difference in conviction for me to hold throughout the last 4 to 5 years of the bear market, per se. Nothing much to disagree on. I completely agree with their assessment, and in fact, I wouldn't encourage anybody to also partake in this endeavor. Now, on the second point, which is top-heavy to the point of vertigo. So the first 3 lines, which is Alibaba Hong Kong, Tencent, and Alibaba ADR, it's up 45% of the pie. And one of those is literally the same company in a different wrapper. So concentration can create fortunes, but it usually destroys them faster, especially when the fate of 2 tickers is already joined at the hip. And it's true, I think I initially started out with the ADR for Alibaba because it's a lot more palatable, and I started out a lot earlier with a very small portion of my income, so I couldn't munch on the very big size, lot size minimum requirement on the Hong Kong market. So after I built out my ADR position and I had more income coming in, that's when I started to build serious position in the Hong Kong market. So yeah, nothing much. I think if possible, I actually don't want to pay the ADR fees. I wanted to convert all of them to the Hong Kong market, but then I have to take on the FX fees and stuff like that. So that's why I'm pretty lazy to do that switch. But that said, I think to focus onto the idea of concentration, to me, I think when I initially started, why I decided to go 100% into Alibaba was mainly because of the absolute amount being something that I can part with. And I think it's a very big investment lesson for myself. Whether is it on a conviction level, the ability to handle volatility, my idea of following a company closely, I have actually took back quite a lot of lessons at the earlier part of building this portfolio. I think for now, especially when the size starts to grow, that's when you see more efforts, or at least more deliberate efforts into understanding more companies to diversify a little bit more. But I think my policy has held true. I had some sort of a mental stop in terms of how much of an absolute dollar amount that I'll put into Alibaba. That's why I have not added to my position anymore, even though I'm still following it quite closely. And my perspective is this, because I just started my whole investment journey, I do look forward to the next 20, 30 years to come, and I will continuously contribute due to both my active and passive income. So that's why I'm more comfortable in terms of having this kind of outsized exposure. Right now, it seems to me like you're just taking a snapshot of my portfolio, but I'm quite sure after 5 to 10 years on, you'll probably see this mix a lot more diversified. At least that's the story that I decided to tell myself. And also one important thing that I've learned is that to not just double down blindly and to allow the winners to prove themselves, or at least for those with a big outsized allocation, they have to be kind of like a 3x, 4x, 10x, and then it become big. And not because of your intentional positioning, like in my case, a very big part of why Alibaba is such a big position is because I intentionally made the executive decision to do so. And I didn't allow for Alibaba to prove its worth and to take up such a big size. I think that's my biggest lesson learned. Now the third point from GPT, redundant and inefficient holdings. Holding both BABA and 9988 is like buying 2 tickets to the same roller coaster. You have doubled FX risk, settlement quirks, and tax admin without adding an ounce of diversification. So VWRA and VOO, your broad ETFs, actually languish under 6% combined. And it's an afterthought rather than a core. So I think the first part of the discussion, I've already talked about why I have this too. In terms of FX risk, I don't think so, because for Hong Kong dollar, they actually peg to the US dollar. So I don't see much of FX risk. But yes, there's a lot of tax, admin, additional fees that I have to pay. But I think for the amount that I'm paying, and for the potential FX loss if I do convert out, I think I'd rather pay the ADR fees in this case. That's why I'm quite uncomfortable in doing the switch. Now, moving on to the ETF conversation about VWRA and VOO. It's an afterthought rather than a call. I can agree to this to a certain extent. So yes, at the start, I had the mindset of a stock picker. I don't want to waste time with an ETF. But I think after some time, I do appreciate and see the relevance of ETF, not in a conventional sense, but more so for one, benchmarking my own performance. And secondly, if all else fails, let's say all my stock picking just went south, I think even though maybe they don't go to zero, but I still have this baseline index holding that allows me to kind of start afresh. Moving on to point number 4, sector and factor blind spots. It's a who's who of high beta tech consumer darlings with virtually zero staples, healthcare, utilities, fixed income, or even cash. So when growth re-rates, there's nowhere to hide. The portfolio's risk profile looks like a venture fund, yet position sizing pretends it's a balanced mandate. So interesting comment here. I think I won't shy away from the idea of not diversifying. Yes, I do have fixed income and cash, but not reflected in this portfolio per se. In terms of utilities, staples, healthcare, I think for one, you need to first have an understanding. I don't want to buy a stock just because for diversification purposes. I already have a broad-based ETF, so that will serve as the diversification utility. Now, going on to all these other like staple companies, your consumer defensive, personally, I'm at least at this stage of my investment journey, I'm not very interested in sizing them into that. I do have a very long time horizon. I'm able to weather out the volatility. That's why I do look at, I guess, so-called higher beta stocks. But just looking at many of these tech companies or consumer darlings, they have a very long runway of growth ahead. I am bullish on that. That's what I'm betting on. And I'm not so much focused into trying to ease out the volatility of the portfolio. That's not my main objective. And in terms of the risk profile, it's very high risk. There's no point about a balanced mandate because the top 2 positions makes up like 45% of the portfolio. It's a mandate to in fact concentrate rather than to diversify. The position sizing in this case, at least for the smaller positions, is really just for me to monitor them. And if after a while I don't feel comfortable, or I still don't see myself picking up the interest into understanding the company at a much more deeper level, I actually just drop them. Not so much because I buy for a more balanced or diversified portfolio. Now, moving on to the last point, which is no evidence of an anchor strategy. Is this meant to be a long-term compounding machine or a momentum chase? Allocation weights, rebalancing logic, and risk limits read like whatever looked interesting on Twitter that week. So LVMH bleeds at negative 20%, while Tiny, TSM, and Meta explode at more than 100%, but still sit mid-tier. So that's anchoring bias masquerading as conviction. Very interesting comment. I think for allocation weights, I don't have a very cold hard way to say that every position must be 5-10%. I don't intend to rebalance as well. So I do agree to the fact that there is no hard-coded logic to it. I really do scale the portfolio based on my conviction level. And why do I have such a big position in Baba and Tencent? Because I feel like I understand them a lot more compared to, let's say, your LVMH or your Lulu, which is still in the process of understanding. So I do concur to the fact that yes, TSM Meta, double, triple bagger, but they still sit at mid-tier levels. It's because of my initial allocation not being a sizable one enough. But you also have to take into account back then on when I bought TSM and Meta, it was during the bear market of 2022 and everything was on discount, and of course I couldn't have expected that Meta and TSM to be the outliers or the performers. And also the context back then was that I don't necessarily have a quote-unquote active income to keep buying the dip, so the initial position sizing was a little bit lesser. So with that in mind, I think feel free to leave in the comment section down below on how your portfolio is currently doing, what are you thinking about, and I'll see you in the next video. But more importantly and hopefully, I'll see you guys on the moon. Goodbye.